So how do you personally evaluate whether an investment is a good fit for you and for your buy box right now?
I mean, this is going to sound really boring. I've kind of taken this from more the institutional buyers out there. We have our spreadsheet, our analyzer, which is, there's a lot of them out there. They're all pretty much the same. They all have generally 50 to 100 different inputs, right? You put in the P&L statement, you put in where you think that you're going to be able to bump the rents up, you put in your reversion cap rate, you put in your escalators and when you think the rents are going to increase every year. You're not going to bump the rents up in the first couple of years. It's going to take a little while for it to ramp up. You factor that in. You see what you're going to make, projected what you're going to make, right? And then if you don't hit a certain threshold, you don't pull on the deal. That we have a certain criteria. We try to aim 2x equity multiplier by the end of the deal, just to baseline it against other properties, though we try to underwrite these properties the same way, the same set of assumptions, right? So like when I look about a bunch of deals out there, that's the first thing I'm going to do, whether it's my deal or somebody else's. I'm going to baseline the set of assumptions. And, because some people, everybody goes on that website, they get their little single family home analyzer and, you show that the rents go up 5% every month. That's very audacious, in my opinion. That's just going to make that up to the right hockey stick graph that everybody likes to see. But that's not realistic assumptions. And, multifamily investing, there are maybe 4 or 5 very important assumptions that I think kind of drive the model. And if people are 80-20, Pareto principle people out there, I think even passive investors need to know what these things are.
I love a lot of what you shared there. I'm a spreadsheet lover myself. I'm also a huge fan of the Pareto principle. I'm curious for people who are eyeing this apartment building investing, maybe they're newer to it. What do you think are those basic foundational assumptions for that market?
Yeah, I mean, the first thing that, most operators are going to fudge out there is your reversion cap rate or exit cap rate, right? This is that one cell in the spreadsheet that is the wild guess what the heck the market is going to be in the future. Nobody knows what the market is going to be in the future. So you try to be conservative and, everybody says the word conservative in their presentations. But, from an industry standard point of view, you try to underwrite the deal where you're thinking that the property is going to be in a somewhat neutral to even worse market in the future. So a very aggressive operator that they're going to be investing in the future where there's improving market, right? That's what you don't want to see. But what the heck does that mean, right? So what you're looking for in a pitch deck, or if you have the underwriting spreadsheet, if you're underwriting it yourself, is you want to use a reversion cap rate, exit cap rate that is slightly higher than what your prevailing cap rate in the market today. So for example, don't quote me on this because these things move a little bit, right? And depends on what submarket you're working with and especially what kind of asset type you're working with. But let's just take Phoenix, Arizona, something that we've had some experience in ourselves, near your Class B multifamily asset. I'm not going to say what submarket is because that's going to throw things plus or minus 0.25% or 0.5%. Back in the heyday in 2022, 2023, at the peak of the market, you're buying properties out there, I think maybe high 4s, low 5s, 5, let's call it 5%, right? Was a prevailing cap rate what these assets are sold at. Today, the market has reset. Today, that those assets are being bought for 6.5 and higher. So, if you're an operator using anything less than 5.5 reversion cap rate, you get killed on those types of assets. If you're buying a Class B multifamily Phoenix asset today, those things might be selling for 5.5 or 6. Let's just call it that, or let's just call it 6 for math's sake. I wouldn't really want to be using anything less than 6.5 on my spreadsheet. My underwriting,
Right.
just use that as a case. So now that we've bored everybody by this, there's a lot of people want to hear about motivation and more of those
That's
tangible
true.
things on a podcast. They don't want to hear about this, right?
I think people want a mix of both. I hope so, because I like to give them that, right? The motivation, the inspiration, the mindset, and then also like something they can walk away with that's concrete. I hope.
Yeah,
But let's
yeah.
switch and talk about that mindset. That was always next on my list. And so, as you moved from, a lot of people start with, like you were saying, the individual doors, these little long-term rentals often. And as you move from that active ownership, single family homes, let's say, into these syndications with these apartment buildings, I'm sure there were a lot of mindset shifts that did have to happen. You're not necessarily a solopreneur, right? You got to let go of control and have your team help out, right? Different boots on the ground because you're probably not in every market you're investing in. What did that look like for you? What kind of mindset shifts or strategy shifts did you have as you went from the single family to the apartment syndication?
Yeah, I mean, to go to the bigger stuff, the biggest thing you need is the KP license, or it's not really a license or a card, but you gotta get experience to sign on these larger loans. So kind of the Fannie Mae, Freddie Mac experience. Unfortunately, it's kind of a chicken and egg thing. You need to be in a deal to get experience to do a deal. So it's really weird.
Right.
Right. So, and it's super frustrating. But then again, it is what it is. And that's the name of the game. So you have to get around other people doing these types of deals to bring you in as more of a junior partner. So you can get that experience in the eyes of the bank or the lender in this case. Even if you've done hundreds of properties, if you never gotten underwritten and put your KP or loan guarantor on one of these loans, they don't care. So that's the first thing. And that's something I realize is like you have to play nice with others and you have to get involved in other people's projects if you're kind of starting from scratch here. And another thing as far as mindset, like at least for myself and the successful people that kind of came up in 2015 to 2020, in that era is kind of when I graduated in a way. You got to be a little bit insane, right? The hardest part of this business is getting your first deal from a broker. I mean, yeah, you could send out yellow letters. Some people teach that. I just think that's nonsense. You're never going to you're not going to send a yellow letter to somebody who owns an apartment building to sell your apartment. I mean, it's just that stuff works on little individual residential non-sophisticated owners, but
Hmm.
for somebody who knows what an LLC is, has one, and owns a 4-unit apartment complex, they're no dummy. They know that they probably should just go to a real estate broker and sell the asset
Right.
there, not off market to some person who writes a yellow letter to them and finds them off market.